Hello and good afternoon, everyone, for joining us for the March edition of Treece Talk with David Treece. Rightly named the session Keeping Up and Carrying On. In today's world, there's a lot to keep up on. So we're going to, it's almost impossible. But David's going to try and highlight what we need to know today, make some sense of it all, and carrying on also, what we need to do to uh, keep our sanity, protect our financial security, and what you can do, some practical tips. So, my name is David Troutman. I handle communications and work with a lot of our online communities through Treece Financial Group, our La Vida Pride and Solo Aging communities, and kind of opening it up for us today. In these times of like craziness and uncertainty and the wild ride we're going through, David came up with a two-word philosophy for our office, our business philosophy being good karma. And that is so needed right now to focus on what we control, positive, how we can make a big difference in other people's lives. So we often kind of look at this when things get nuts and say, this is what we want to do is help people share good karma with people. And we live by our values of advocacy, compassion, inclusion, loyalty, and accountability. So just know that everything we do, we're kind of really focusing on that. If you have questions or have comments as we're going through here, I welcome you to put them in the chat or in the Q&A. Um, I'm going to head it over to David soon, but if you don't get enough of today's discussion, just know that on our YouTube channel, which has a QR code on this screen right now, and it's youtube.com/at Treece Fi. We have a whole playlist of short videos of David talking about different aspects of the economy, different aspects of the Trump administration, and what the effects on the economy may be, called Treece on Trump. So you can kind of check out those videos. We just uploaded 4 new ones in the past week to take a look at. And I am going to bring David on with me. Hello, David.
Hi there. I hope I'm not sure if everyone can see me. Um,
They can, and I
th-
wanted to. Yeah, I
there we
just wanted.
go.
Yeah,
Um,
just
adjust this a little bit. Welcome everyone. Thanks for being here. It's like David, you're right. There is a lot going on in the news, but
exactly.
I want to share that I live in an alternate universe to what I think a lot of people think. Investment news here. This is the most recent edition. And David, you make it sound like maybe some negative things are happening, but here there's a lot of positive thoughts from the investment world. Brian Story, head of multi-asset strategies at Brinker Capital, talks about this Trump administration with a more focused, more experienced, and more professional administration, more professional. It's likely that the new Trump administration will more effectively translate his policy objectives into action. Jim Thorne, chief market strategist at Wellington Alpha, says he expects a more moderate approach this time, offering as evidence the wide range of political voices and backgrounds in Trump's cabinet. Wide ranges, professional, moderate. This moderation contrasts with Wall Street's perception of Trump as radical, while it was actually Biden's policies that were more extreme. Once the market recognizes this reality, we can expect a significant bull rally in stocks and a decline in interest rates. Oh, okay. This is investment news. This is the most recent edition, policy prognostications. As for the economic, business, and tax policies likely to emerge, wealth managers target deregulation as the most significant, not just for the market, but for their businesses as well. And the comments are that these policies are expected to usher in an era of robust, non-inflationary private sector growth. Not a negative comment or negative thoughts in said. I'm like, oh, okay. Well, on the other hand, and please feel free to ask any questions as we go along. The Terra Investment Management, which again I think is just outstanding. This is just a brief overview of what we're going through. The S&P 500 saw its biggest decline of 2025 yesterday, fueled by news around the tariffs. While tariffs were in the spotlight, economic data also weakened. I'm going to emphasize this. With high uncertainty, diversification is even more prudent. We believe in this, but we did another video. The diversification that we do is with money managers who will pull money out of the market, get in, get out, tactical. And we will blend those managers. And we are having success with that. It is very interesting to see the results in this downturn by doing this, because some managers are already out of the market. They have made this decision that it's too volatile, and so they're out. And others do better on the upside, others maybe protecting on the downside. But here, to go back to the commentary from Cetera Investment Management about all of the economic uncertainty, that the tariffs, the weakening economic data sent the equities markets lower, especially the tech sector. Declines are continuing. President Trump said that 25% tariffs on Mexico and Canada are set to begin today. I'm going to make another strong comment here. This is where I have a big mouth. So many people who have supported him would say, "Oh, it's just a negotiating tactic," and he's not really going to do this. He's not really going to free some of these insurrectionists who were violent and were convicted and even assaulting police officers. Well, he did it. It's like everything he says he's going to do. Oh, he's not really going to do it. Take him seriously, but don't take him literally. Okay, I disagree with that. Everything he said he's going to do, he's doing, and I expect more. So this kind of environment is not just a normal economic environment. There's a lot of negative news here. Another one, the Atlanta Fed published a model forecasting GDP, the gross domestic product, in real time, and estimates for the first quarter that GDP growth fell 2.8%. And that is severe. And a lot of this is self-inflicted. The lack of confidence, consumer sentiment, consumer confidence. So the overall picture is that the economic growth appears to be slowing. Tariffs are only compounding this. Again, this is Cetera Investment Management, and creating more uncertainty. Tariffs are being used as a negotiation tactic. I disagree. They are not being used as a negotiating tactic. They are bullying. They are meant to degrade, to attack our allies. We are abandoning foreign allies. It's despicable. And I think there are other strategies going on here. And I think it's going to get worse. When you talk about Canada as the 51st state and putting a 25% tariff on them, this has nothing to do with illegal immigration from Canada. This has nothing to do with fentanyl. This is absolutely an attack on an ally, and intended to be an attack on an ally. Talking about taking over the Panama Canal, talking about buying Greenland, which isn't for sale, talking about expelling 2 million people from Gaza and turning it into some Mediterranean paradise. All of this is on the table. All of this could happen. No more denial, not from me. So we are headed for chaos. That's my prediction. Unlike the other advisors, but I want you all to hear that, there are people who are optimistic, who believe in the deregulation, who believe in the tax cuts, and who are optimistic. Now, here's my big mouth again. Get ready. Financial advisors, most of whom are older, white, male, conservative, Trump supporters. Our records are public. My record is public through FINRA, broker check. You can check our background records, and I always encourage anybody who's working with an advisor to do that. Go to FINRA, FINRA, the Financial Industry Regulatory Authority, FINRA.org, broker check, put in the name. And what you're looking for are disclosure events. That is fines, customer complaints is one of the big ones. That is legal problems, liens, judgments, bankruptcies, legal problems. And I ask financial advisors, if Donald Trump were a financial advisor, what would his record look like in terms of those disclosures? Probably be 400 pages. And this is, in fact, he would not even be eligible as a convicted felon to be a financial advisor. It is disqualifying. So here we have financial advisors speaking highly of somebody who was not even eligible to be a financial advisor and who would really look terrible on their disclosures, which are public. So just to give some perspective, a different perspective on that. So I have a lot a lot of concern about what is happening, and there is a lot of negative economic news. So I mentioned consumer sentiment and consumer confidence. Those are two different measurements. The consumer sentiment index from the University of Michigan that the Fed of St. Louis follows. Then you also have the Conference Board, which does consumer confidence. These are hitting lows for multi-month into multi-year lows. And this is a concern because this is a forward-looking economic indicator. If consumers do not have confidence, then they stop spending. And that leads to economic problems, a contraction, or as the Atlanta Fed is predicting, a contraction 2.8%. Satara says here, the impact of these tariffs is uncertain as the implementation will dictate the size and the scope. There's also a potential government shutdown. Government job cuts will also contribute to slower growth concerns. We also had high valuations on stocks, which is true. We've had 2 years of double-digit growth in the stock market. So valuations have been stretched. A lot of what we are seeing was laid out in our 2025 market outlook. Economic growth will moderate, and the Fed is likely to cut rates less than markets expected. Well, I recorded this back in November. I expect 0 rate cuts. Now, if things go really badly and the government needs to stimulate, the Fed needs to stimulate the economy, you could get a rate cut. Or you could get the worst of both worlds. You could have high inflation and a weakening economy, weakening unemployment, which we had before, so-called stagflation, which is where I predict now. Is it going to be a mini stagflation? We'll see. Nobody knows for sure, but there's a lot of negative signs here. This is where I want people to be invested according to their risk tolerance. Some people are very aggressive long term, and you can make a lot of money sometimes in down markets. Things are on sale. You may be wanting to get out, and that's where we have plans to do that. You may want things that are safe and fixed and a good interest rate. We have that. And again, I'm going to say we get offerings from insurance companies that have interest rates. Those interest rates are going up. They're not going down. They are going up. I predict 0 interest rate cuts at this point based on all the information we have. 0 interest rate cuts this year. And here, while economic growth appears to be slowing, we are not expecting a recession around the corner as the labor market remains solid. Well, we'll see about that. I'm not so optimistic. A recession is typically defined as 2 consecutive quarters of negative economic growth. It looks like we're already possibly, according to the Atlanta Fed, having the first quarter of extremely negative economic growth. Will there be a second one? That would constitute a recession technically. So we'll see. One of the things to point out here, a correction or a 10% pullback from the peak is possible and could take the S&P down. However, keep in mind, corrections typically occur about once a year on average, which is absolutely true. And even when the market was up a lot last year, we definitely had not corrections, but we have some serious downturns. The last correction wasn't, it was all the way back October 2023. So the bottom line is it's prudent to be well diversified to mitigate risk. And again, I think the diversification means not just stocks, bonds, 60%, 40%, large cap, mid cap, small cap, international, domestic. I think it means in and out of the market tactically and diversified managers who do that, as well as some things that are just safe, fixed, and without any risk. And there are some ways to do that as well. So I have a million opinions on what is happening. I'm not happy about it. I think it's self-inflicted, monumental irresponsibility and ugliness. And the thing is, I always say this to bring this back to a more positive thing is always focus on what you can control. The one thing I like about some of the money managers is they're not doing anything that is up with a political bias or that is emotional. It is algorithms. So it is the only problem I have with that is a lot of what is happening is self-inflicted. It almost seems like intentional damage, maybe for other longer term results. But that's where we are right now. We're watching things very carefully, and we are trying to give people a lot of support as to risk control and perspective. The there are always tough times, and we get through them, and hopefully we will get through this. But there's going to be damage. A lot of people are having terrible damage. On that note, if anybody has any questions or comments, we can open it up for questions. It's quite a mouthful.
Well, that's great. Thank you, David, for that insightful analysis on the current market landscape, all the potential of the impact of these policy shifts. It's clear that while there's opportunities for growth, navigating this uncertainty requires a different kind of strategic approach, and you laid that out there. So now let's open the floor for your questions. Please see that Q&A button in the Zoom panel, whether it's about market volatility or portfolio protection, or maybe just the economic trends. Please feel free to enter them into the chat or the Q&A, and David will be glad to answer. And I have a question here, and you don't have a name here, but I'll read the question. I know the tariffs just took effect today, and there was an immediate effect on the market, but will they continue to create deeper and deeper market losses, or will they level out at some point?
Typically news-driven events are somewhat temporary. That people have a reaction. I always give Brexit as a great example. The market was not expecting the vote for Great Britain to leave the European Union. And then boom, it happens unexpectedly, the market tanks, and then a few days later, things are recovering. It would not surprise me if some of this is temporary. Another thing, not to be entirely negative, as I think I was a bit negative there, if the war in Ukraine is resolved, even if it means conceding territory, which I think is awful, that could stabilize the markets. That could be actually cause the markets to go up. I think the markets also like deregulation, as I mentioned there, and they like tax cuts. So all of these things could happen that could really stimulate the market. One problem with that is it can also be inflationary. And so then you're not going to get rate cuts from the Fed. So a lot of what people wanted is not around the corner in terms of lower inflation, lower interest rates, like to buy a house. These things are still very problematic, and I don't see the tariffs making this any better. The argument for tariffs historically has been protectionism. You're trying to protect an industry at home, and clearly, we could have that with semiconductors. After the pandemic, the idea was we need to make sure that we produce things here, so it can be strategic. But here, it doesn't seem like it is intended to protect industries exactly. It seems like it is to punish allies or punish China. And I think there's some other ideas here about this being a source of revenue for the government, even though it's a tax, and that, of course, this idea that, oh, this is just a negotiating tactic, that we're going to get Mexico to put troops on the border to try to control immigration and drugs. That could be part of it. That could be a byproduct. But then, of course, you get the tit for tat. And it's, as Justin Trudeau said, there's a price to pay. And generally speaking, free trade causes economic growth, and restricting it causes contraction.
Thank you, David. Jesse Walters asks, you mentioned that much of this is self-inflicted. Would you discuss what the long-term goals might be? Because it generally seems more like Trump's personal list of revenge, retribution, and long-held personal gripes.
I agree with that, and you can see that in several of the things that he's done. For example, the pardons, some of the people that he's appointed, the retribution of going after the law firms that were involved in the lawsuits against him, the mass firings of people. There have been all sorts of reports of these emails going out, questioning, are you involved in a union? And these, you have targets, clear targets. And I think it's created an atmosphere of fear. And so people are not afraid to speak up or they're going to get fired. And, that's been happening. There have been purges. There are more norms to possibly be broken. For example, defying the courts. Excuse me here, my ranting. It's like, I absolutely agree. None of this is normal. None of this is professional. I think there's a lot of denial, abandoning an ally, doing deals with Putin. I think there's a lot more here that is really disgraceful. And we'll see where it goes. But no, I would agree with Jesse that people have agendas. They're here to do those agendas. There's so many examples. Another one is the Foreign Corrupt Practices Act. Here this is like the anti-bribery law, so that you don't have American corporations doing the wrong thing internationally. And it has been said we're not going to enforce that unless it has to do with drugs, drug cartels. Otherwise, it's like, okay, do what you have to do business. And you see these oligarchs in both Russia and the United States now, trying to do whatever they want. And there's just no respect for those traditional norms and standards and protections. And the courts keep stepping in and saying, no, you can't do this, you can't do this. In the past, I think governments would not have even attempted to do some of these things, knowing the courts are going to strike them down. And here, this is the opposite. You do it and you wait for the court to step in. And then you see, of course, it's too late for a lot of people. Sometimes the courts are saying, no, these firings are not legal, and yet they're already gone. What do you do? So I think eventually there will be a price to pay for all of this.
Linda asks, can we assume our portfolios are protected as best as possible, or do we need to set up a meeting?
I love that question. One of the things we're trying to do is to communicate like this as well, because people have questions and concerns and we share them. I'm going to give myself some credit, unlike these other advisors who are just optimistic and it's like, oh, this is a temporary pullback, things will be fine. I share some of these worries. So my feeling is we've been trying to get people set up, excuse me, for this kind of a risk. So we've been working with these managers for years, and also with things that have guarantees like the annuities. So I think we do want people to review their portfolios. We are willing to make changes. We are suggesting in some cases to make those changes. We always want to do annual reviews, at least once a year. It can be more often. So if people have concerns, because it's chaos for us right now, and I'm telling that to people. If there's something minor that you wanted to discuss, that may have to wait. But if people have concerns, absolutely, we will do meetings and review portfolios. Some things I'm not as concerned about because the managers are already out of the market, or it's like under an annuity guarantee. So you're in the market, but you have a guarantee there. So I've been trying to respond to people. If you can't get a meeting with me, because we're like so slammed right now, still we can do a phone call, or I can respond in an email. But we want people to know that we're on top of things, and we will make recommendations. But mostly we've done this proactively in advance. And I'm really happy with some of the portfolios. I'm looking at these, believe it or not, some of these blended portfolios, as I'm recording this, are up this year. And it is, others are down slightly, but it's, that risk control pays off. And then there's an emotional benefit for it that you're not so worried about it. And that's what we want. Again, it depends on your risk tolerance and your time frames.
Great. We have another question here, posted by David Trotman. What, if any, are the risks of shutting down the Consumer Financial Protection Bureau, or the CFPB, to my financial portfolio?
It's not to the portfolios at all. It is to the possibly banks or other institutions that might do something wrong. And so you have this Consumer Protection Bureau that would go after them. And there were lawsuits, there were fines. They're trying to protect the public from various abuses. And so the idea is to get rid of these regulators. And some of the lawsuits have already been dropped. And there still isn't, it's one less guardrail for the consumer. There's no doubt about it. It's interesting. Our industry is so regulated, and I would say often over-regulated and inappropriately regulated. The people who want to do the right thing often get hamstrung, where the people who are going to do whatever they want, don't care about all these rules to the same extent anyways. And so sometimes I think these regulations backfire. But the idea here, and that's what people want. They want fewer regulations. But there is a lot of abuse out there. I mean, look who's in the White House. Look at all the abuse there. Look at all the bankruptcies. Look at all of the judgments, and including a criminal conviction for a felony. So you do need appropriate regulations. Go back to the Great Depression and FDR. They created the SEC and all of these regulations. So it's a balance, and you don't want to be so overregulated you restrict economic activity. But then there has to be a way to make sure that people do the right thing.
All right. Well, thank you, David, for this advice. Just one last question that I have here, and feel free if you do have another question that you would like to ask, please put it in the chat. But here's the final question that I have here. And just as we're saying, yes, there's some downside risk protection and watching out for losses. Let's ask if an investor can strategically position themselves in sectors that benefit from deregulation and economic expansion, while also navigating trade policy shifts and tariffs to mitigate risk and capitalize on global investment opportunities. Pretty much just making things positive out of this negative situation.
The answer is yes, that they can be done, but I think in some ways increases risk because you're talking about sectors. So you could be in a technology sector, a healthcare sector, a country-specific sector. There used to be like the BRICS. I mean, it still exists: Russia, Brazil, Russia, India, China. So we do have portfolios like this. We have like a souped-up S&P 500 that's really tech-heavy. So there are no brakes on it. It can go way up and way down. So one of the problems with the sectors is not the risk, but its concentration. So a policy change, the tariffs, a sector that you thought would do really well may do poorly. We've seen, for example, a huge shift in Europe. All of a sudden now, international markets are, for the first time in a long time, outperforming the United States. And that may continue. So the defense sector in Europe is soaring right now because of the United States, in my view, abandoning Ukraine disgracefully. And so now they're investing a lot of money. And this also increased risk exponentially because they're indebting themselves, they're selling bonds. I look at the debt levels in the United States, $36 trillion, and the attitudes are still, and this, all parties are guilty here, of still not, this idea of firing all these federal workers is somehow helping control the budget deficit is preposterous. All of this expense is basically in Medicare, Medicaid, Social Security, defense, interest payments. And until you solve those problems, and the idea that you care about the budget deficit when you're willing to do huge tax cuts, it's preposterous on its face. It's totally it's a lie. Any politician who gets in front of this a group and says we're trying to control spending, we're trying to cut back, we care about the deficit. No, you don't. Then that means you oppose these tax cuts, and they don't oppose the tax cuts, and they're very likely to pass and be extended. There will be some conservative Republicans who will vote against it like before, because they know it's going to blow up the deficit by trillions over the years. What does this do for Social Security and Medicare? I mean, right now we've got a cushion, but we're just kicking cans down the road and creating more problems and making the system more fragile. And that includes internationally too. So these are interesting times we live in. Now, there could be a huge backlash to all of this that seems to be building, and maybe the next elections, the midterms in 2 years, the next presidential election, it'll go back. And I don't like huge pendulum swings, but we'll see what there's reasons for optimism always. And it's so interesting to me. Of course, people know my husband from Argentina, and we were down there when the whole economy collapsed and the banks closed, December of 2021. And it's like, people find a way to get through. We got through the pandemic. We got through the housing crisis, the everything crisis, 2007, 2008. And of course, there's damage. Not everybody got through it economically. Of course, many lives were lost during the pandemic, but life goes on, and we just have to be optimistic that we will get our act in order here. Those are my opinions. But one of the biggest things I wanted to say is there are a lot of people in the investment world that are optimistic, and I expect very good growth this year. It's despite, I think many of my clients and myself are really concerned. You need to have that diversity of opinion, and I want to share that with you. Some people are positive. And
okay, David. And Robert's wrapped up with the questions. So, any final parting words of what to pay attention to, or to give us any final advice before you sign off?
One of the things, of course, I'm a geek on these things. I look at the economic reports, the next big one, Friday, unemployment. So you look for signals as to where things are going. And so, we're going to keep looking at those things. And, one of the arguments is that, Trump does not want to fail. He doesn't want the stock market to go down. He doesn't want the economy to fail. And if things look like they're not working, we'll do deals, things will change. So, we'll see. It sounds so reasonable, but, that's speculative. It remains to be seen. Right now, there's just nothing but recklessness.